Hey folks, welcome back to the channel. Today let's talk about mortgages. In 2023, should you go with a fixed rate or variable rate? Now, if you're in the market to buy a property, first of all, good luck to you because there just aren't a lot of inventory out there right now. The process to build new homes is very slow, and people living in existing homes don't want to move because the vast majority of homeowners with mortgages will experience a substantial increase in their monthly payment if they sell their current home and get into a new mortgage, even if the size of the mortgage is the same. But if you are fortunate enough to find a home that you like at a price you're willing to pay, should you go with variable or fixed? Well, let's look at historically how much each type of mortgage costs over time. Here we can see a graph where the green line is the fixed rate and the teal line is the variable rate over the last 16 years or so. For the most part, you can see that fixed rate mortgages are typically more expensive than variable rates, which makes sense because when you go fixed, you're guaranteed that rate even if interest rates go up. So I think the best time to get into a fixed rate mortgage is when interest rates are low and there is a small difference between the fixed and the variable. For example, here you can get a variable rate mortgage for 1.99%, but if you're willing to pay just a little bit more, like 10 basis points, then at 2.09%, you can lock in a fixed rate for the next 5 years. So I think that is a good time to go fixed. Also around 2020, variable and fixed rates were pretty much about the same. So around the end of 2019, I actually bought an investment property with a fixed rate because it wasn't that much higher than a variable rate. But what about today? Well, something rare has happened, which is that the variable rate, the teal line here, is now higher than the fixed rate. So the variable rate right now is 5.8%, whereas you can get a fixed rate for 4.9%. Actually, I think the fixed rate just went up a little bit higher, but you're getting a maybe 80 basis points or 0.8% difference between variable and fixed. Now, because variable rates are typically lower than fixed rates, and it's rare to see this current scenario where fixed rates are actually lower, it would make sense that for the next 12 to 24 months, rates are actually going to go down, and this inversion of rates that we're seeing is going to flip back, and we're going to see variable rates lower and fixed rates higher. Now, whether that means fixed rates go up more or the variable rate comes down, I'm not sure, but most likely what's going to happen, as I'll explain in a moment, is that both of these rates are going to fall over the next year or so, but the variable rate is going to drop more. And even if it doesn't, going variable is probably better anyway, because if rates are dropping, then as long as it drops more than 0.8%, on average over the course of your mortgage term, then that's going to be worth it. So although for fixed rate, you do get that safety and peace of mind, knowing that your cost of the mortgage isn't going to move over the next 5 years, there is a cost that comes with that certainty and privilege, which is the risk of interest rates dropping, and you lose out on that potential savings of falling interest rates. So one reason I would go with a variable rate today if I were to renew my mortgage or get a new mortgage is because historically, when the variable rate moves above the fixed rate, it's not long before both of them start heading down. Another reason is because variable rates, on average, have saved homeowners more money in the long run. And this is what economists have figured out, studying mortgage rates over a long period of time. Of course, this doesn't factor in individual economic situations and risk tolerance, but just looking at the financials itself, it seems like for the most part, going with a variable rate is the better choice. Now, the third reason is because of where I think inflation is going over the next 6 to 12 months. From the Bank of Canada's website, they have a mandate to keep the target range of inflation between 1 and 3% over the medium term. And right now, inflation is on its way down and it's at 3.4%. So it's very close to that band within 1 to 3%, which is this gray horizontal bar over here. Now, for a very long time, it looks like the Bank of Canada has kept inflation in check within their 1 to 3% range. And it was really only just over the last couple of years from 2021 until the middle of 2022 that we saw this spike in inflationary pressure. However, that is coming back down. And as you can see, we are very close to that 3% upper limit of the 1 to 3% range. And ideally, the Bank of Canada wants to get inflation to 2%. And I think we're probably going to hit there before the end of this year. So if you were to guess if interest rates are going up or down next, here is a look at the Bank of Canada's interest rate policy, which is this blue line, and then you have CPI inflation, which is this red line. In early 2021, inflation started to pick up, as you can see here, and the Bank of Canada was late to try and curb that because they thought it was just temporary. So for all of last year, the Bank of Canada was chasing inflation, basically raising interest rates, trying to bring inflation down. But now we're at a situation where inflation, the most recent reading at 3.4%, is lower than the Bank of Canada's benchmark rate at 4.75. So if you're choosing between variable rate and fixed rate, you can ask yourself, what is the likelihood of interest rates going up and what is the likelihood of it going down? So when I look at this and I see inflation is dropping, commodity prices are dropping as well. If you look at food prices, they're down from a year ago, energy prices as well. So I think there's a pretty good chance for inflation to continue dropping from here, and it won't be long until we're back at about 2% inflation. And if that were to play out, is there a really high chance that the Bank of Canada will increase its interest rates to 5% and higher? Probably not, because at that point, there's actually a bigger risk that inflation might drop too low and the economy starts contracting, and that's not good for policymakers. So when inflation was higher than the Bank of Canada's policy rate, it makes sense to continue increasing the interest rate. But now that inflation is lower, and most likely it's going to continue falling, I think there is a higher chance that the Bank of Canada's next move is going to be down. And even if they do raise it from 4.75 to 5% over the next, I don't know, 2 or 3 months, then as long as inflation continues to drop, then I think there is an even bigger chance that the BOC is going to cut interest rates later this year or early next year. Because if the bank's mandate is for inflation to fall between 1 to 3%, and then inflation falls within that range, I just don't see any reason why they would continue to increase rates based on their own mandate. Now, the last reason I think a variable rate mortgage is better is because of my interpretation on economic growth over the next couple of years. Because one thing you can think about to determine if rates are going up or down is to consider how strong you think the economy will be. Because if lots of people are getting jobs, GDP is growing, people are being more productive, then you would expect interest rates to move up. And in that kind of environment, then getting a fixed rate mortgage would make a lot of sense. But if you think there's a recession coming, people finding it harder to stay employed, and a contraction in the economy in general, then interest rates are probably going to fall as policymakers try to accommodate for a weaker economy by making it easier to borrow money. And the economic data to me looks kind of weak. If we just look at the GDP growth number as a proxy for how the economy has been doing, you can see that over the last year, Canada's gross domestic product growth has been 2.21%. So around 2%, low 2% annual GDP growth rate. And, that's not terrible because it's better than being negative, but there's a couple of things I'm noticing here. First is that overall, ever since the middle of 2021, the trend has been going down. You can see it's making lower highs, so this high is lower than this high, and it's making lower lows because this low from the previous quarter is lower than the previous low over here in the first quarter of last year. So overall, the economy is slowing, and if this trend continues, then it's going to drop even lower over the next few quarters. But a more concerning issue is when you look at this in context with our population growth. Last month, Canada's population surpassed 40 million for the first time, and that probably caught a lot of people by surprise. It didn't seem that long ago that we were celebrating 35 million, 37 million, but now all of a sudden it's 40 million. I don't even remember seeing a 39 million milestone. It just went up really quickly, it seemed like. And part of the reason is because the population growth has been accelerating over the last few years, gaining 2.7% just over the last year, the fastest growth since 1957, during like the baby booming times. So we pretty much skipped over 39 million because, according to this tweet from Ben Rabideau, Canada just gained 1.2 million people over the last year alone. So if the population continues to grow at 1.2 million per year, then in 8 years, we're going to be celebrating 50 million people. And, 8 years is not that long. So as you can see, for the longest time, our population has been growing at about 400,000, and then there was a drop in 2020, 2021 before a massive surge up. So if Canada has 40 million people and it's growing by 1.2 million a year, then that means the population is growing by 3% a year. So if the overall economic output is growing by 2% a year, but we're adding 3% more people into the country, then on a per capita basis, it means on average, people are actually making less money. We're producing less goods and services on an individual basis after you account for population growth. And this is on purpose. The government knows that the economy is not doing so hot, but they also want to control inflation. So what they do is they raise interest rates so CPI doesn't get out of hand, but they know that doing so will cause an economic recession. So what they do is bring more people into the country. So instead of having organic growth in GDP, we're getting pretty much all of the growth from new immigration, which misleads the public into thinking our economy is not that bad, it's going up by 2%, when in reality, the average person is not making more money than this time last year. But this has its limitations as well. They cannot just keep artificially pumping up GDP by bringing more and more people into this country, because at a certain point, there's going to be a maximum pain threshold hit where there just aren't going to be enough housing in the country to accommodate those millions of people coming into Canada. And people wonder why housing prices haven't been going down. In fact, in many parts of the country, home prices are going up. They're more expensive now than a year ago. And this is part of the reason. There's just a lot more demand for housing than there are new supply. So I think as more people lose their job and the economy drops further, the Bank of Canada will be forced to cut interest rates. And it's not just Canada, it's the entire global economy that I think is going to have a recession over the next 6 to 9 months. When we look at the United States, the number of Americans filing for unemployment is going up. There is some choppiness, but the overall trend is heading higher. So by the end of this year, I expect the unemployment rate in both the US and Canada to be higher than what it is now. Also, in just a few months, a lot of Americans' discretionary spending is going to drop because for the past 3 years, 40 million Americans with student loans did not have to make any payments and did not accrue any interest. However, in September, they will get notice again to pay, and those 40 million Americans will have to start making payments again in October. And when you make payments to student loans, then that means they have less money to buy other goods and services, which probably means that in the last quarter of this year, 2023, you're going to see a pretty big hit to GDP in the United States. The average student loan payment is about $500 a month. So for the past 3 years, 40 million Americans had an extra $500 a month to spend on whatever they want. But they're going to have to adjust their budget this fall. So when they start to pay down debt instead of buying new things, that is going to be a big deflationary event. The money supply is going to drop. The amount of currency in circulation is also going down. Paying down debt essentially means you're destroying money, and there will be less liquidity in the economy and in financial markets. So I think over the next 6 to 9 months, Canada and the US will head into a recession. And that is going to prompt central banks to not just pause on their interest rate hikes, but actually go the other way and start slashing them. Now, I don't know over the next year or two how low interest rates could go, but if you believe that they're going to cut them, then it sort of makes sense to me to get a variable rate mortgage today than a fixed rate. Now, of course, I could be wrong and there could be a black swan event. If there's a large geopolitical event between China or the US or China, Taiwan, anything like that, we could have a large disruption in supply chain again, and we could see another wave of high inflation, in which case interest rates may actually go up instead of down. So there's always that possibility, but I think the odds are that in 1 year from now, both inflation and interest rates are going to be lower. And that's why for my variable rate mortgage, I have not locked that in. And when it comes to renewal, I will probably stick with another variable rate, unless something in the economy or my personal situation changes between now and then. But apparently, I'm in the minority because most people now are going for fixed rate mortgages instead of variable rates. In fact, according to Statistics Canada, the most recent data shows that just under 8% of newly issued mortgages from the big chartered banks are variable. That means people are going for fixed rate mortgages 92% of the time right now. And I can certainly see why, because the Bank of Canada is very hawkish in their tone recently. I mean, they were dovish over here back in 2021, saying that they don't have to raise interest rates and saying that they will keep interest rates low for a very long time and that inflation was only 1% at the time and there's nothing to worry about. Even in 2022, when inflation was higher, the Bank of Canada was still very dovish, saying that inflation is just transitory in nature and that this was a temporary increase in the cost of living because of a temporary increase in the cost of energy and food. And there was no plans to raise interest rates anytime soon. And at that time, a lot of people believed the Bank of Canada, so they were going for variable rate mortgages since fixed rates were more expensive. So fast forward 1 year later, and what is the Bank of Canada saying right now? Well, they've completely changed their tune. They're super hawkish now, and they're saying we're probably going to raise interest rates more. We have to fight inflation. We have to get it down. They're really trying to get people to think that they are serious about keeping monetary policy very tight and possibly increasing rates more into the fall. And they're not going to drop them for the rest of the year. And that's pretty much what the US, the Federal Reserve, is saying as well. And if you were to believe them, then of course you would be getting a fixed rate mortgage these days. However, if you look at history, it's clear that they are very bad at forecasting economic conditions. When they were most dovish, inflation was about to take off. And now they are most hawkish, so I'm a little skeptical. To me, this is a contrarian indicator because to get inflation to come down, they have to make people think that inflation is going to come down. And because I think there's a lot of room for interest rates to drop, getting a variable rate now over the long run, like for the full term of the mortgage, is a better idea than getting a 3 or 5 year fixed. But we'll have to see what happens. I mean, 92% of Canadians would disagree with me because they're choosing fixed rates instead of variable. So maybe I'm missing something here, but let me know what you guys think. If you were getting a mortgage right now, would you go variable or fixed? At this point, there's no right or wrong answer, but it'll be interesting to see where the economy goes and where interest rates go over the next little while. Anyway, thanks a lot for watching. Good luck with your finances, and I'll talk to you in the next one.